Well, good evening and welcome to the TandemGrowth Financial Advisors Mid-Year Investment Review. I am so pleased that you decided to join us this evening, and I hope you'll find some of this content helpful to you as we talk a little bit about what's going on recently in the capital markets and share some information from some of our resources around the economic activity and what's going on in the economy. As is normal, Jamie Stoltz is assisting me tonight. So if you have any technical difficulties during the presentation, please reach out to Jamie. She can be reached at 770-641-6360, extension number 4, or you can reach her at jamie@tandemgrowth.com. I do welcome questions. We do record these so we can share them with a broader audience. So we're just going to ask that you use the chat feature or the question feature in your webinar panel. If you have questions, please type them in there. And at the end of tonight's presentation, I'll pull them up and we'll have some conversation if you have any thoughts or questions. Obviously, if you have questions that you're uncomfortable asking during the presentation, you can always reach out to anybody on the team as well, as you know. Times certainly have changed. This time last year, markets were down. The U.S. equity market was down about 20% for the first 6 months of 2022. Year to date, through the end of June at least, just shy of 17% advance in the S&P 500. Bonds last year had a historically bad year. By the halfway point, they were down over 10%. Year to date, bonds are up about 2%. This time last year, the annualized inflation number as measured by the CPI was about 9%. And today, it's trending about 4% on an annualized basis. Last year at this time, the previous quarter was negative, just barely negative, but it was negative. And the most recent quarter, about 2%, a little north of 2% GDP growth. So while it's still quite slow, according to that measure, we're certainly not in a recession. The Fed funds rate was 1.75% this time last year, as the Fed was early in their hiking cycle. And today, the Fed funds rate is at 5.25%, so significantly different. Similarly, this time last year, the most recent Fed meeting, the Federal Reserve raised rates 75 basis points. Well, in the most recent meeting, the Fed took a pause, which we'll talk a bit about. So this just in. The end of the world has once again been inexplicably postponed. And so again, as we came into the year, the consensus was, the U.S. economy is likely to be in a recession this year. Well, so far, the economy seems to be more resilient. So far, we're not in the U.S. in a recession. The Federal Reserve says it's not done tightening yet, but again, the consensus is it's getting a whole lot closer. The inflation picture, again, still has a long way to go to meet the Fed's 2% target, but it has obviously, as I just mentioned, moderated considerably. Corporate earnings are down a bit in the first half of this year, but again, a lot less than the consensus was forecasting in a recessionary environment. We had, a lot of challenges around congressional debate around extending the debt ceiling. And there was a concern that the U.S. government would default on its debt. Well, that didn't happen. The dollar has depreciated a bit this year, but again, compared to some of the forecasts, not as significant as was forecast. And then finally, we had 3 of the top 4 banks in the United States failed this year. You may not have noticed it looking at the equity markets, but so far, no contagion. It's been limited. And of course, the government has stepped in with policies that were probably helpful. So the way I like to think about it is being a shareholder in the world's great businesses. You're capturing global growth when you own great businesses, but they're also an expression of human ingenuity. And so over the last 50 years, the S&P 500, not even including the dividends, is up over 32 times. And so why is the S&P up over 32 times? Is because earnings were up over 35 times. And over time, the value of businesses follow the growth in the aggregate in profits or corporate earnings. Well, why were earnings up 35 times over the last 50 years? Well, one reason is the population has grown. I mean, we've got a larger population. So it's grown from about 210 million to 333 million. Probably the more significant reason is productivity. The American worker, the productivity of the American worker has skyrocketed. Adjusted for inflation, meaning real GDP per capita, so per person, has gone from about $26,000 to over $60,000. So these earnings were propelled by innovation. And one way to think about that, the players that do this innovation change over time. As a matter of fact, 9 of the 10 largest companies in the S&P 500 today didn't exist 50 years ago. So that's really the story here. We're capturing global growth, and the market is an efficient way to do that. So one of the other things that makes it really astonishing is over this 50-year period, where the value of U.S. equities have gone up 32 times, not even including dividends, as I mentioned, over that same 50 years, on 3 separate occasions, the S&P fell 50%, half by half, in 3 separate occasions over this 50-year period of going up 32 times. And so the lesson from all of this will not be a surprise to anybody on this call. Excuse me, I went one too far. And the lesson is, those that have a perspective that this too shall pass, that markets are self-correcting over time, and that over time, the value of businesses follow corporate earnings, and over time, corporate earnings follow growth of the economy, and the growth in the global economy is positive about 70% of the time. So people that have this long-term perspective and say this too shall pass have tended to do much better than those that say this time is different and change my strategy because it's different this time and we need to do something different. So let me give you a quick survey of recent results. These are just the broad asset classes as the end of June. And as you can see, large US stocks up, as I mentioned, just shy of 17% year to date. Small company stocks up about 8%. So far this year, large has beaten small in terms of returns. International developed markets are up just north of 11% year to date. So year to date, US equities have outperformed international. Emerging market equities up just shy of 5%. So developed international much better than emerging international. Global real estate up about 2%. Bonds, as I mentioned, year to date up about 2%. International bonds up 1.5, 1.43, and then cash, short-term treasuries, 1 to 3 month treasuries are up 2.33% year to date because we have relatively high yields on short-term fixed income instruments. In the 3 years following the pandemic, companies that had lower prices relative to earnings or lower prices relative to other financial metrics that we'll call value stocks. So in the 3 years coming off of the pandemic, value stocks outperformed growth stocks by a fairly significant margin. As a matter of fact, over the trailing 3-year period, even today, that's true. However, as you can see, year to date, large growth has beaten large value by a fairly significant margin year to date. Large growth up about 29%, large value up about 5%. The same is true in international markets. Year to date, large growth international up 14.5%, large international value up about 10%. Now that is reversed, as you can see on the green in the emerging markets. Year to date, emerging market value has outperformed emerging market growth by a small amount, as you can see there. So as normal, I'll spend a few slides here presenting some information from JP Morgan's Guide to the Markets resources, which are terrific. And I'll share a few thoughts from their team. Dr. David Kelly is generally presenting these types of ideas in their resources. And so I'll present some of their ideas. As you know, we are not economists, but we do obviously pay attention to their information. So I thought I would share a little bit of it. And so again, as we have already talked about, the U.S. economy remained resilient in the second quarter of 2023 and has widened the runway for a potential soft landing in terms of economic growth. However, a quick look around each sector of the economy tells us that the economic momentum is in fact slowing. Business spending appears to be one of the most at-risk areas in the economy, in particular the manufacturing sector. And I'll show a slide on this in a moment, but the service sector continues to do quite well, and a lot of that is travel. People are still traveling an awful lot, but the manufacturing sector has deteriorated significantly. Recent layoffs in the tech sector could also have an impact on research and development spending in the future. Probably one of the biggest clouds are vacancies in both retail and commercial real estate, and that can have some fairly significant impacts on both the economy and the banking sector going forward. And consumers are starting to have felt the pinch from inflation and higher interest rates, and are cutting back a bit on retail. So that's kind of where we're at. The consensus for economists, does believe that the U.S. economy should continue to grow at a tempered pace, so slow growth from here. But a slow growth economy is much more sensitive to external shocks that could occur. And so there's still a lot of risk on the horizon, most notably, as I mentioned, commercial real estate and a recession. So these are things that certainly could affect not only the economy, but the equity markets as well. The labor market has been a bright spot throughout the expansion, that started essentially coming out of the pandemic, but cracks are beginning to emerge in the employment picture as well. Recent employment reports have shown the economy continues to add jobs at a robust pace, but the trend is slowing a bit recently. There is improved labor force participation that you can see in the top right graph here. For those aged 25 to 54, those over 55 and up, many have left the workforce and have no intention of coming back. But again, the labor picture has been generally a bright spot, but it's still a pretty tight labor market for employers. So that could have some implications for corporate profits, which we'll talk about in a moment. But the employment picture has been surprisingly robust during some of these uncertain times, I guess. This tight labor market has allowed the unemployment rate to hover around its 50-year low, which so despite cooling demand, you do still have really low unemployment from a historical standpoint. The cooling labor market has also contributed to moderation in wage growth, which helps with the inflation picture, but it doesn't help the employee and spending a whole lot. But wage growth has slowed down a bit. Year-over-year wage growth is about 4.3% from the previous year. The reading in March was about 6%. So that seems to be moderating, just a bit. The big story last year obviously was inflation. It's still a big story, but it certainly was a big story last year as we went through this transition with the Federal Reserve, trying to take the punch bowl away. But it's now steadily declining after, hot inflation, affected our wallets for the last couple of years. And so headline CPI has come down from its peak of 8.9% a year ago to just over 4% in May. A modest monthly pace of core inflation has been sustained for about 7 months now. So these are all very positive developments. The major hotspot of inflation for the last 2 years have also turned to contributing factors, and disinflation in some of these key components has been helpful. Shelter inflation has been the stickiest part of core, and it's eased a bit. So while inflation is not falling as fast as the Federal Reserve would like, it is gradually falling to a much more manageable levels. Many economists are expecting CPI inflation to decline to around 3.5% to 4% year over year by the end of this year, and down to around 2 to 3% by the end of next year, even without a recession. So those are just, obviously forecast from the consensus, I guess, if you will. So despite economic headwinds, equity markets have had obviously a solid 2023, supported by better than expected first quarter earnings and expectations that at some point the Fed is going to stop tightening and potentially even start reducing interest rates. So profit margins, rose significantly. They rose 11.7%, indicating that companies have had success in defending their margins. And so, they've been able to raise prices essentially. That said, there's risk remain, certainly to corporate profits, earnings. If there's a recession, obviously corporate profits would come under pressure. And I guess something we'll talk about in a moment as well, while performance this year has been better, much of it has been driven by rising valuations. So it wasn't based on earnings, it was based on more people bidding up the stocks in this low interest rate environment. And so money is left, over time has left low interest rate investments and moved over to equities. But and it's been a fairly concentrated market, as we'll talk about in a moment. If you take the dividends out of the S&P 500, the price return this year is about 15%. So if you strip out the dividends, and of that 15%, the top 10 companies return makes up 13.8% of that return. So it's fairly concentrated in a handful of stocks that we'll talk about in just a bit. So, expectations for the Federal Reserve lowering interest rates might be optimistic. And so expectations may have to be adjusted. The most recent Fed meetings, as I mentioned, they were a little bit more hawkish in terms of the pace of stopping. But the slow growth, potential from a recession or slowing economy and continued rate increases could put pressure on earnings and equity prices in the near term. So obviously something to at least be aware of. When we look at interest rates, again, the Fed left rates unchanged in the last meeting, and this was telegraphed to the market. But as I mentioned, forward guidance was pretty hawkish, meaning they indicated that it was a pause, not a stop. And so if you look at their dot matrix here, these little dots on where the Fed governors predict the Fed funds rate will be in the future, they're showing in late 23 or maybe early 24 that the Fed funds rate will be at 5.6% instead of 5.25% as it is now, indicating probably two more interest rate hikes. So those are all things that just to be aware of. And so in 2023, the global economy has gained speed. This is a heat map of the Purchasing Managers Index, which is a good indicator of economic momentum. Now, this is a global chart, so it shows you growth. And just simply, the darker the shades of green, the better. It means you have, growing economic activity. Red and yellow and the lighter colors are obviously slow or negative. And a reading over 50 is considered to be growth, and so a lot of the globe now is growing again. And we've some tailwinds in Europe. Energy prices did not go up as much as was anticipated. It was a warmer winter, I think. China opening up has had some indications, although they've still got a lot going on there. But so there has been some tailwinds with things like that as well. One thing I will point out is if you look at the manufacturing PMI, it is red. And so there is still a difference in the US between manufacturing and services. So services has been really holding up the economy, and obviously there is concern, how long that will last. We talked a little bit about the dollar. I just put this in here because people ask these questions a lot about the dollar. The trade-weighted dollar has weakened by about 10% since it reached a 20-year high last September, and it's stabilized a little bit more recently. But again, it depends on interest rates, but it could weaken further in the coming days. The question that most people ask as it relates to the dollar is, will we lose the privilege of being the world's reserve currency? So the United States is in a uniquely privileged position to be the world's reserve currency, which is supportive of the dollar. And so while the US dollar share of global reserves has declined modestly, it remains the world's preferred reserve currency, accounting for almost 60% of the world's reserves. And so the gap between the dollar and the euro has seen a little change. It's still kind of in line with historical averages. And no other currency has more than 6% share of global reserves. So, I think investors should recognize that periods of decline, might not necessarily mean, periods of decline in the percentage that are using the dollar as reserve, but there's nothing that indicates that the dollar is going to lose its status as a reserve currency, at least for now, despite political wrangling. It's like Mohammed El-Arian used to say, or Bob or Bill Gross used to say, we're still the cleanest dirty shirt. So we got a lot of the global world has, governments have challenges. We have them, but other countries have them worse. And that's a relative game. As I mentioned previously, this is some of the more interesting parts, I think, of the presentation in terms of the equity market year to date. And much of the year-to-date return, as I mentioned, came from just a handful of stocks, and it was generally due to multiple expansion, not growth of earnings, but prices just getting bid up higher and higher, that I'll show you in the next slide. And so if you look at what Charlie Biello at Creative calls the enormous eight, these are the returns of these top 8 stocks. So Nvidia is up 190% year to date, first half of the year. Facebook up 138%. Tesla up 113%. Amazon up 55%. Apple up 50%. Netflix up 49% year to date. Microsoft up 43%, and Google up 36%. Now, I'll mention as an aside, many of these were down dramatically in 2022. So some of these returns, while they're incredible in terms of how much they've gone up in 2022, you still need to take probably a longer view on trailing returns. Now, most of these, again, or many of these have incredible trailing returns. So at any rate, these top stocks, you can see the returns there. However, the equal weight S&P 500, so if you just look at the 500 companies, the average is up 7%. And that average of 7% includes these 8. But the equally weighted S&P 500 is up 7%. So the market's been dominated. The 17% return has been dominated by the exposure to these handful of large tech stocks. And so now the price earnings ratio of these top 8 is, in the stratosphere. And so as you can see, they're all trading at significant premiums to the S&P 500. And I believe the measure used here for the S&P 500 are current earnings, not projected earnings, but the S&P is trading at about 25 times current earnings. And as you can see, Amazon's trading at 301 times earnings, and Nvidia is trading at 224 times earnings, and so on and so forth. So in other words, it takes you 301 years of earnings in Amazon stock to get back your original investment. For Nvidia, it takes 224 years of profits to get back your investment in Nvidia. So they're quite rich. And kind of like the meme stocks of 22, and there's a lot of excitement about artificial intelligence, AI. And so this is just, a measure of searches on Google for the term AI stocks. And as you can see, it has skyrocketed. And, AI and artificial intelligence is exciting, and it has a lot of potential applications across all businesses. The problem is kind of figuring out who's going to be the winner and loser. And I'm reminded of that a movie many years ago. I think it was called Tucker, about a car manufacturer. Well, back when the Tucker was around, I mean, there were 100 car manufacturers, and of course, about 30 years later, there were 3. So trying to figure out who the 3 are can be challenging. The same with the internet. Back in 1995, 96, 97, 98, 99, it was an exciting, and the internet, changed our lives, but it was impossible to know who's going to be the winners and losers. But more importantly for my conversation today is many of these companies and these stocks are now trading at really, really high multiples and have characteristics that do not bode well for investors that invest at these levels, at least from a historical academic standpoint, meaning for future results. So if we just back up a minute and look at the S&P 500 again on these similar measures, at the end of June, these top 10 stocks were trading at about 30 times earnings, and the rest of the S&P was trading at about 18 times earnings, which is historically not cheap. It's probably fair valued on the average stock and overvalued on these 10 companies. So while there has been a trend for exceptional growth, now they're quite expensive, and therefore expected returns are much lower. If you look at the top right chart that I've got there, you'll see that these 10 stocks now also make up about 32% of the S&P 500. So if you own an S&P 500 market cap weighted index fund, you've got about 32% of your investment in these 10 stocks, essentially. And so, we caution investors from chasing, the top 10 stocks. This is not going to come as a surprise to anybody who's been on these calls in the past. So as companies grow to become some of these largest firms trading, the returns that push them there can be impressive, but not long after the top 10, these stocks on average lag the market. So from 1927 through 2021, the average annualized return for these stocks over the 3 years before they got in the top 10 was 25% higher than the market. So pretty impressive. 5 years after joining the top 10, these stocks were on average underperforming the market, a stark turnaround from their earlier advantage. The gap was even wider 10 years out. And so Intel is an illustrative example. The technology giant posted average annualized returns 29% better than the market over a 10-year period before it got into the top 10. And then in the subsequent 10 years, it underperformed the market by 6% a year. Similarly, the annualized excess return of Google 5 years before it hit the top 10 dropped by about half in the subsequent 5-year period. So again, we would just caution investors from concentrating in in the 10 stocks that have done well recently. So last year, we had a broad sell-off in both stocks and bonds and many other asset classes, except maybe commodities. And these lower valuations, presented investors opportunities for higher expected returns. And so while the year-to-date advances have helped that, have benefited investors, there's still compelling values in many sectors of the market outside large U.S. growth stocks. Consumer sentiment has recently staged a bit of a comeback, but again, still low by historical measures, and could go lower, if we have more banking crisis or a recession or interest rates go up rapidly and home prices fall. I mean, there are many factors that affect investor sentiment. What's important to note about the slide, however, is investor sentiment is a contrarian indicator. In other words, the worse people feel is historically been a pretty good precursor for higher subsequent returns. And the better people feel is a precursor of lower realized returns historically. And again, it makes sense because when people feel bad, they sell assets and they get cheap and expected returns go up. And when people feel good, they bid up prices and stocks and bonds and real estate gets expensive, and subsequent returns are lower. So it's not complicated to understand why, but be that as it may, sentiment has gotten marginally better, but still quite low. So as the U.S. stock market has on average outperformed the international markets over the last 15 years, really since the Great Recession, many investors argue that international diversification is no longer necessary. I'll just put all my money in the U.S. market. And the outperformance of the U.S. stocks has led to this favoritism of, quote, local investments over international ones. And these are really classic behavioral biases that we all have. One of them is a recency bias. So we look at recent results and we extrapolate that out in the future. And another behavioral bias is one where we confuse familiar with safe. And we see this all the time with people that own a lot of their own company stock. They'll think since it's familiar to them, it must be safe. And the same could be said with investing in US as opposed to international. It's more familiar to us, I guess, and therefore it feels safer. But that's dangerous. So if you look on the chart here, from 2000 to 2007, US equities were up 1.7% per year, and international equities were up 5.6% per year, and emerging market equities were up 15.3% per year. So if we were meeting in January of 2008, and I showed you these trailing returns, and I told you that we weren't going to put any money in international investments, you would probably question that advice based on recent results. And so just similarly, things do run in cycles, and the things that drive excess returns are the things that make prices go up. And so now, relative to the US, international equities are compelling values. And so we want to be obviously globally diversified. We're making a big mistake, we think, if we're not globally diversified. And in the US markets, the CAPE index, the Shiller CAPE index, which is the cyclically adjusted price earnings ratio. So it basically looks at 10 years worth of earnings, at the average 10-year earnings divided by current price. And historically, it's been a pretty good measure of long-term returns, not short-term. It's real noisy in the short term, but long-term returns. And as you can see from this chart, the shaded blue area is the CAPE index, this 10-year CAPE index. And when it gets high, subsequent returns tend to do poorly, and when it gets low, subsequent returns do quite well. And so when you look at the markets today, US versus international, international valuations are quite compelling relative to US. And so again, I won't beat this anymore, but I'm just suffice it to say, you don't want to give up, in our view, on international diversification, especially now. Back in June, middle of June, I wrote a blog that I tried to put a frame of reference around some of the things that we're doing in our portfolios. We've always done, but I think the communication was even more important as these handful of stocks were driving the market. And we were not overvalued. We were not over allocated, as I mentioned, to some of these more expensive, low profitability, concept stocks. We have a more diversified portfolio and tilt to those factors that have higher expected returns. If you'd like to read or learn more about that, probably the best thing to do is just go to the TandemGrowth website. You go to the tab that says Money and Meaning Online, hit Perspectives blog, and you can find the article or the paper I wrote back in the middle of May that talks a little bit about how we think about these tilts. And probably one of the most important concepts is, on a relative basis, companies that have low price multiples and high profitability. So companies that are cheap relative to the fundamentals and have higher profits have tended to do much better than companies that are expensive and have obviously low profits. And these relationships are robust across large companies, small companies, US stocks, international stocks, and emerging markets. And so even if we have a downturn in the markets or the economic activity, again, by having lower price, more profitable companies can be better defense than the more expensive, less profitable, high investment companies. This is another chart that takes from Ken French's website that looks at data going back to 1963, and it's the top grid is basically a classic 2x2 matrix looking at big companies, small companies, and expensive and cheap. And as you can see, small companies compounded significantly higher. Small, low price stocks have done much better than large, expensive stocks. When we look at the bottom matrix, it's looking at low investment or high investment and comparing it to high profits and low profits. And what you can see is high investment firms with low profits do the worst. And again, that's what a lot of these concept stocks basically are. They require a lot of capital investment and they're low profit. And so, the earnings yield, which is the inverse of the PE ratio, so it's earnings divided by current price, is as good a measure as we have for a predictor of future returns. Actually, it's future real returns, so returns after inflation. So if we just do a survey of the market as of today, I did this off of Morningstar today, so these are values for Morningstar as of yesterday. And if you look at the total stock market, and I just used the Vanguard Total Stock Market Index Fund as a proxy for the total market, it's trading at 19 times earnings, which would imply an earnings yield of 5%. So if you just flip it and do 1 divided by 19, you get about a 5% earnings yield, which is a pretty good estimate of future returns for for the total market. The large growth index is trading about 30 times earnings, and therefore the expected return around 3%. International stocks are better, as I just mentioned, trading at about 13 times. And again, these are just Vanguard index funds. So that implies an earnings yield of 7.6%. Again, a reasonable predictor of long-term expected returns. Emerging markets at about 12.5 times earnings, so 8% expected returns. Small value. Now in this one, I'm using an actual product that does look at both profitability and low price equally. In this particular product, the stocks in this product has a PE ratio of 8.71%. It's small value, which implies an earnings yield of about 11.5%. And then finally, small value using a product that does the same thing, that looks at both profitability and price, trading at about 7.8 times earnings or an implied expected return of 13%. Now, these are not short-term prediction vehicles. They are long-term expected returns based on price, based on price and earnings. So I don't want to make this like we've got a hot tip for you on what to go load up on. It just gives us some indication of at today's prices where the best value is over time. And as the first quarter indicated, it doesn't mean that you'll have higher realized returns in the very short run, because investors may chase a handful of concept stocks because it's the flavor of the day, if you will. So, where will the S&P 500 be at the end of the year? Where's the 10-year yield going to be? Where's oil? When's inflation going to be stamped out? How many Fed rate? We don't know these things. No one does. And so I think what we need to do as investors is, first of all, build a financial plan and construct a strategic portfolio that has a high probability of capturing these market premiums to fund these plans, but invest based on the probabilities and be humble and thankful and leave the predictions to those whose job it is to entertain, because that's kind of what it is. And so the best you and I can do is to try to find a path that's right for us uniquely and individually that we can stick with, so we can reap the enormous benefits of compounding over time. So thank you for your attention for my lecture tonight. I'm hoping you found some value in some of this information. On the screen here, I've got our unique process for those of you that are not clients. If you'd like to learn more, those of you that are on the call, if you found this helpful, please share it with friends. You could subscribe to our email distribution list for our blog and our podcast and other things that we put out periodically at info@tandemgrowth.com. We'd love for you to check us out on social media and like us and whatever you do on all those things. It does help with getting some traction for people that do internet searches for wealth management firms, and we'd appreciate that if you found it helpful. If you're not a client, you can check us out on the website. You can schedule an introductory call if you'd like to do an introductory call to learn more about the firm. No cost, no obligation, get to know you call. And again, you can make this year the year that you put your plans in place. My final commercial before we get to questions, if there are any. I did publish a book at the end of last year. Most of you on the call are on our list, so you're aware of this. If you'd like to learn more about it, it's available at the online retailers, and it's also on Audible as an audio version, as well as a Kindle or a Kindle version. If you would like to check that out and share it with all of your friends. Thank you again. If you have any questions for me and the team, if we can help you in any way, I've got the best wealth management team in the world. Please reach out to us. Don't be a stranger. If you have any questions about any of the content, again, I'm going to open it up for questions now, but feel free to reach out or schedule a personal interaction with me or anybody on the team. And so I'm looking here. So far, there's no questions in the queue. I did get one question prior to the webinar, and it really was talking about mortgage rates. It said, with mortgage rates at 20-year highs, what's the outlook for the housing market in 2023? And obviously we're not economists, so we don't really have a real qualified opinion. I can just tell you what we've read and what the research has told us. But obviously, as rates have gone up, it has made homes much more expensive to the buyer. And for people that are in their home, I think I read the other day, like 70% of homeowners, or maybe 80% of homeowners, have mortgages under 5%. So if you've got a mortgage that's under 5%, you're probably unlikely to, to be able to go buy another house, sell your house, and buy another one at a favorable rate. So some people are stuck in their home. So I think there's a lot of inertia to not at these mortgage rates, but we still haven't built enough houses. There's a shortage of houses, so there's still a feeding frenzy with people trying to find houses, and so that can help with home prices. But if rates go up further, it could obviously be damaging to the value of your home. The flip side of that is, if the Fed raises rates and throws us into a recession, rates will come down, but your home value will also likely depreciate as well. So, impossible to know, but there's just a couple of thoughts. Yeah, I've got another question here. What do your sources predict may happen to real estate? Again, the residential is what I was just referring to about mortgage rates. I think I'm fairly stoic about home prices, and probably I'm stoic about it because I'm not trying to buy a house. You know, I didn't just get my first job and making money for the first time and starting a family and try and buy a house. So maybe I should be a little more sensitive to that demographic. But I know that since the Great Recession, we haven't built enough houses to meet household formation. And so I think the housing market will do just fine over time and be cyclical. But it is a leading indicator to other parts of the economy, because obviously people don't do home improvements and other things. Now, the thing that I would be most concerned about, and I am concerned about, that we just need to be aware of, is the commercial part. And maybe that's what you're asking. What do the resource people predict about commercial? And the problem with commercial is just a lot of debt. There's low occupancy. I think I read in most major cities, occupancy rates now are like 50%. And a lot of these developers and institutional owners of commercial real estate have short-term loans that are maturing in the next 24 months. And so banks are tightening up because of some of the concerns with these banks that failed, as I mentioned, which also bleeds into the broader economy, small business. But these developers and these operators of large commercial properties that have to refinance their debt, they may just decide, to give the property back and move on. And so that can have a cascading effect, and it bleeds into all parts of the economy. The long answer to your questions, I mean, everybody has an opinion. I think if you're a developer and you're trying to raise money, your economist is saying this too shall pass. Don't worry about it. It's not going to be a problem. If you're a credit analyst and you're looking at all the debt that your hair's on fire, and you say these guys are going to be bankrupt, and it's going to be a problem for the banking sector, and it could be the next shoe to drop with the economy. So I don't really have a good answer other than the opinions are quite mixed, as they usually are. Let's see. This one I think might have been part of that. REITs, long-term growth outlook given vacancy. Yeah, same thing. I mean, I think global real estate has historically been a good diversifier of portfolios, but at today's prices and yields and risk, certainly they're not near as attractive as they were. And from a portfolio design standpoint, we can get some of the same benefits in small value stocks, quite frankly, as you get in real estate. So in our strategies, we have a market cap weighting to publicly traded real estate, which is about 3% of the equities is in global real estate. And that's just, as asset allocators, we think that that's reasonable, but I think the near-term outlook is quite scary if you're in certain types of properties. Now, distribution centers, data centers, for all this computing power with AI, there are medical buildings. I mean, there are parts that could weather the storm even with some of these rollovers. And apartments are still doing really well in terms. And again, it's because rents are short term. They get to raise rents as inflation and their inputs go up and so forth. So I don't have a great answer other than it. I think it's a little scary today in terms of having an over allocation to commercial real estate, but not knowing, again, we try to have a broadly diversified portfolio and have some exposure, but we want to be, obviously, you'd like to be careful. Let's see, I've got another question here. This looks like a good one. With the popular ETFs in the last few years, do you expect mutual funds to lose their popularity in the long run when compared to ETFs, which can be identical but cheaper? I mean, the short answer to the question is yes. I do believe that you will see a continued migration more to exchange traded funds from mutual funds. And there's been a lot of, one of my favorite quotes from Charlie Munger is, there hasn't been, I don't know the exact quote, but I'm going to paraphrase. There hasn't been a useful financial innovation since the ATM. That was the Munger quote, and I think he's wrong about that. ETFs and some of the newer actively managed ETFs or strategically managed ETFs, I think, are offer a lot of opportunity, and we use them in our strategy. So there's commercial for what we do. I don't. But long answer, I think more and more investors will be in ETFs and mutual funds. Traditionally, people have used them more in taxable accounts, but because of cost and some other factors, I think they'll even become more popular in tax sheltered accounts as well. They do involve a little more complexity in trading for the average investor when you trade an ETF as opposed to trading a fund. But I do believe the advantages outweigh all of that if you understand how to trade them. So long answer, yeah, we do believe that mutual funds will probably lose market share to ETFs in the future because of superior design in the way the products are constructed. So those are great questions. Thank you for asking those. I don't see any more in here right this moment. Thank you for all of those. Feel free to chime in again by email, me or anybody on the team, if you've got more questions, comments, or feedback. I appreciate it. Obviously, all kind of disclosure here, I'm going to put on the screen for you to check out. I mean, we're using indexes in these illustrations, and none of this is designed to be personal advice to you. We would ask you to rely on your own counsel and financial advisors and tax professionals and so forth. But I appreciate your time today. Have a great evening, and I look forward to seeing you next time.